When is the right time to refinance your mortgage? Well, first of all, everybody's situation is unique. Everybody has different needs, but let me just offer you a few general guidelines when it comes to making the right decision on the time to pull the trigger for a mortgage refinance. First of all, you have to ask yourself the question, how happy am I in this home? How long am I staying in this home? And am I going to be here at least 5 years? It's my belief that you really need to stay in a home about 5 years for it to make sense financially for a refinance. That's because it's going to take you some time to recoup the cost of that refinance, which leads to point number two. Point number two would be when we're looking at the break-even point on making our money back, I want to see at least 3 years. I want to see that when we compare what you're paying right now on your mortgage versus your new payment, that the savings will come fully into play for you within a 3-year period. If we get that, that's a nice start. We want 1% off the interest rate. We want to make our money back in 3 years. We also want to look at total interest to be paid over the life of the loan. So we'll look at the current loan and calculate how much interest is remaining to be paid based on the remaining term of your loan versus how much interest you would pay on a new loan over the course of the life of that loan. So look at the difference in interest, subtract out the cost. That's going to be your profit if you keep the loan to full term. What about taking cash out? Because I've been talking about a no cash out refinance here. When we're taking cash out, I like to see my clients in a situation where they're taking out at least $100,000. If it's a smaller amount that you're taking out and you need, let's say, $50,000 or $75,000, and you have a very large first mortgage, I would check out a home equity loan or a home equity line of credit first. Okay, because we're talking about smaller amounts of money, and if you've got $500,000 or $600,000 that you owe on your home, and your rate is in the 2s or the 3s, we probably don't want to touch it. Okay, we'll look at a home equity line of credit, a home equity loan, second mortgage, before we go into touching that first mortgage. But once we get to $100,000 or more, then I think we've got a conversation to start. We're going to look at the rate on your first mortgage. We're going to look at the reason why we're taking out such a large amount of money. Are we doing home improvements? Are we paying off high interest credit cards? And those credit card rates now are 20%, 30%. They're up there. And there's no possibility of writing off any of that interest. However, when you consult your tax advisor, there may be the possibility of a tax deduction on a cash out refinance. But again, consult your tax advisor. So that it comes into play as well. We also have for refinances, sometimes it's a personal reason. You're buying out a spouse, buying out a sibling of the home and need cash out. Those are the cases where we're really looking at the need and less on what the rate is on the current home. So what you really want to do is think carefully before you refinance. I know you're getting a lot of emails, a lot of phone calls saying refinance now, because what you don't want to become is a serial refinancer. And that's somebody who refinances every couple of years, and that's going to do a number on your personal wealth and the equity in your home. So think carefully before you refinance.